Welcome to the HMO Property Show, by investors for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I have been out on site looking at some of the deals that we've been doing lately for some of our clients. And whilst there's been some challenges in the construction industry, I'm not going to say that everything we do is flying. Some things are, some things aren't. And I think when you've got the volume of projects that we do have in the ground right now, there's always going to be challenges in some way, shape or form. And it's our responsibility for our clients to resolve these problems, which we always do. Like, we haven't any projects that we can never build or anything like that. Sometimes some of them might get stuck in council because they've never seen what we've done before, and then we jump in and we rectify the problem. Sometimes there's financing issues, etc., etc. But we always get these things moving. So I jumped in the car the other day to go check on the projects, but to make some content as well for social media, just so people can see what we're doing. And every single deal I went to visit, I was just blown away when I checked the numbers of what we paid for them, what the build costs were, and then more importantly, like what they're worth now, because as we know, construction prices are continuing to go up and land prices are continuing to grow up. So if anything, this podcast is specifically for the fence sitters, you know who you are, who wanted to take action 12, 24, 36 months ago, but didn't because they were concerned about the prices of everything, the prices of land, the prices of construction, etc., etc. And to indicate, like, even in the short space of time, how some of these projects have increased in value, and also like the gross yield that's expected for the clients in these deals. I've actually thrown one of my deals in there as well. And for all you net yield lovers, to kind of throw a rough figure at that, but and I'll work that out live without any mortgage against it as well, because the lending landscape is constantly changing in this space right now. And again, it's our responsibility, our job to make sure that we've got an outcome for our clients. So firstly, I jumped in the car and I didn't go further than 16 kilometers from the office. And that's it. Like, my house is around the corner from the office too. So literally 16 kilometers from where I lived is where I went. I visited 8 properties on 5 different sites. And hang on, 3, 4, 5, 6, 7. Yeah, 8. And like the first property I stopped at was 8 k's from the CBD. Infill location. I just looked online. There's 0 blocks of land available in this suburb right now. Capital growth in this location has gone through the roof as well. And this was a project that we picked up and subdivided into 3 lots. And then we packaged them up and sold them as 6-bedroom, 6-bathroom properties to our network of clients. And the reason that we did that is because if you've been following us for a while, you'll probably know that we're not a massive fan of the fringe suburb greenfield subdivisions and just putting product in there, because this is where all the marketing channels go, and we have the skills in-house to find and develop and deliver quality products in quality areas. And that's why that we focus on these infill locations, so we're not getting pulled into the fringes constantly and just competing with all of these other sales channels that all they're doing is just trying to sell a package. They've got no property management company in place, they've got no strategy in place, nothing like that. So we picked up this location, or this site. We subdivided it in 3. We packaged it up because we knew there's loads of demand in this area. We knew that the location was prime for capital growth as well. Each of the clients paid $400,000 for the block, around 815k for each build. So they were in the deal for like 1.25 million. And our early feasibility show that the rooms would rent out for $425 per room. So that gives each client, let me just quickly work that out for you. 425, my apologies, times 6 is $2,550 per week. Times that by 52, it's $132,000 of gross income against a $1.25 million property. So that gives the clients a 10% gross yield, 8 k's from the CBD, premium location. There's no way that area is going to get saturated with HMOs from sales channels, because A, there's no land available in that suburb right now, but B, no one else has the skill set. Well, I'll say no one else. Obviously, other people have the skill set and the experience, But no one else is applying that to the HMO space right now. Everyone's looking for ways that they can develop land and hit their 15% margin on development. So the more important thing about this now, if we did subdivide these blocks again, we could probably get $500,000 per block, and the build price has increased from $815 to $950. So straight away, them packages that were $1.25 million are now $1.45 million, which on paper, the clients have got a 200k equity gain. And we can get these properties revalued once they're built and redraw some equity out of them as well. So not bad. More importantly, let's talk about the net yield on these properties, because I'm getting hammered on Facebook at the minute about net yields. And I think it's important that we talk about. So 132,600 of gross income, take away 5% vacancy, brings you down to $125,970. Take away a 15% property management fee, brings it down to $107,074. Yep. And then we've got to take $20,000 away for gas, water, electric, internet, cleaners, insurance, council rates, water rates, etc. Brings it down to $87,000 for a property of net income before mortgage. Now, if you've paid $1.25 million for this, you've got a 20% deposit, which is about $280,000, which means you'll have around a $860k mortgage. And if you've got that, then you'll have an interest rate, let's say, sitting around 6%. I'd say you'd be paying around 45, 50 grand a year in holding costs on that property. So let's take 50 grand a year from that 87. These were $37,000 of net cash flow on an interest-only loan. So not too bad. Not too bad at all, actually. Next one, drove around the corner. We went 15 k's from the office. And we had, this was actually a really good deal. And this is when I thought, we've done some absolute ripper deals, absolute crackers. And this is one of them, right? So the block was marketed as a 489 square metre, I believe it was. 470, I think it was 437 square metres. No, sorry, we paid $439,000 for it. It was a 480 metre squared block. So the block next door sold and somebody got approval to build a single story house on it. But when we looked at the zoning in this suburb, we realised that that block of land was zoned R20, R40, but it was being sold by the agent as an R20 site. So we picked it up for $439,000. We got the build and the subdivision for $800,000. Oh, I just told you the secret, the subdivision. Damn it. But yeah, building the subdivision for $800,000. So all in, 1.23 mil. Not too bad. It looks like a decent deal. $380 a room times 6 is $118,000 of gross income, which gives you a 9.6% net yield. So if you could get a 9.6% net yield, 15 k's from the CBD, I think you'd be pretty happy about that. But as we mentioned, this was actually, it had subdivision potential, and we knew this when we picked it up and presented it to the client, but the client didn't have the capacity to build both houses at the same time. So we designed it in a way so that we only presented one house. We designed both houses on the block, and then we removed one and submitted one to council and got the approval for the one. And then once we got the approval for one, we lodged for the subdivision with WAPC whilst we built the house. And technically, what's happened is the client has ended up with another block of land for free, really, because he's happy with a 9.6% net yield, 15 k's from the CBD. So if he's technically got that block for free, and he's building another 6x6 on there, which now costs around $950,000, that means no land costs in there, $380 a room times 6 gives him $118,000. Which gives him a 12% gross yield on that property because he got the second block for free. So I came away from that deal, I was like, man, that is an absolute cracking deal. Great location, 15 k's from the CBD. You can probably walk to a train station in like 11 or 12 minutes. And again, instantly this client's sitting on like 350 to 400k worth of equity from that one deal. So an absolute cracker of a deal. I then drove around the corner again, same suburb. We picked up a bigger block this time. This was about 530 square meters, street facing. Picked it up for 455k, and for $776,000, we built a 7-bedroom HMO. Now, no one else is doing these deals. 7 and 8 bedroom HMOs. People are just doing 6-bedders. We started doing the 6-bedder with the granny flats on. And this is one of them properties. So instead of putting a 2-bedroom granny flat on this one, we decided to put just a 1-bedroom granny flat and just make the granny flat really big. So if we've got, again, 380 per room times 7 is $138,000, which gives the client an 11.5% gross yield on that property. 15 k's from the CBD. This one's actually closer to the train station than the other one. You can probably walk to the train station about 4 or 5 minutes from this one. So again, an absolute cracker. From there, I jumped back in my car and I was excited. I was like a kid in a candy shop, as they say. I jumped in my car and literally drove on the other side of the river. This one was only 16 k's from the office, so kind of in line with the other properties, but on the other side of a river. And this is what we call it, infill greenfield location. What does that mean? That means that a developer's picked up a decent sized block of land, and instead of doing a Nigel Satterley and bringing like 2,000 to 5,000 lots to the market, this developer's found a small block that is anywhere between like a 5-lot and a 30-lot subdivision. And that subdivision itself is actually landlocked as well. So it's not like they can release this stage and then release another stage and release another stage and another stage. It's literally just landlocked. That was it. We paid 375k for the block. But the interesting thing about this is we actually contracted on this one about 8 months before titles were issued. And now blocks in that same suburb are selling for $475,000. So technically we've made around $100,000 on the block alone. And that was before we even settled on it. It's an absolute cracker. The developer knew this as well, so he was really turning the screw on us when we were due to settle. Yeah, they could have pulled this from us and sold it for $100,000 more, and that just goes straight in the bottom line of the developer, right? But instead, it went in our pocket in terms of equity. Now, again, we picked up our 7-bedroom HMO model, so a 6-bedder with a single granny flat in the back, single-bedroom granny flat. All in, we were in for $1,080,000. So we probably made about 150k worth of equity in that deal alone as well. Room rates, we're expecting the room rates to be 375-ish. So again, you can see that we're hitting that 11 to 12% gross yield on that one too. And then last but not least, I hope you're keeping up with all this different deals and different numbers. So we drove to a suburb which is 12 k's from the CBD, close to the airport, lots of infrastructure. And this, I believe, is an absolute cracker. So this was the first deal that we actually lodged in 6-bedroom property with the 2-bedroom granny flat on there. And we picked up an 827 square metre block in 2023 for $370,000, 12 k's from the CBD. Realestate.com alone is estimating that to be worth $700,000. And with this house on it, it'd be worth even more because the build for this 8-bedder, there's quite a lot of retaining in this block. It's a bit slopey, and the build was 962, but right now I think you'd be looking at like 1.2 mil for that same build with the retaining. But the client, technically, if we picked up the house next door and lodged if we lodged a finance application and we got the valuers out to value it, there's a good chance that the valuation would come in at like $1.7 million. So technically, again, made between $300,000 and $400,000 worth of equity. We won't know it until we actually get this thing revalued and try and pull some cash out of it to go again. But 8 rooms at $375 a week gives them $3,000 a week of income. That's $156,000 of gross income per annum on 11% gross yield, 7% gross yield. So for all of my net yield lovers out there, let's work that one out. So 156,000. Take away 5% vacancy is 148k. Take away 15% plus GST as a property management fee is $125,000. And then I'm going to take away $25,000 away from this one because it's a granny flat, so it's got some additional costs in there for electric and water and stuff like that. Gives you 100 grand of net income before holding costs. Now, what did he pay? 962. So he paid 1.33. 1.33 or take away 20%. So he's got $1 million mortgage and at 6%. So his holding cost at 6% interest only is $63,000. So 100k, take away $63,000. It's $37,000 of net cash flow after all expenses. This is why I am very passionate about what we do. This is why I love what we do. This is why I can jump out of bed every morning just loving the challenges that this thing brings. For the people that have actually took action and have done deals with us and seen equity uplift whilst they're getting cash flow from the same deal, thank you for taking the leap of faith with us. I know it's a big investment and a very unproven strategy in this space as well. And I honestly think that the early adopters in this space are the ones that are probably going to make the most money as this becomes more and more prevalent. I think we've told you about the pension fund we're working with. These guys are ready to drop cash any minute now. SPVs are being set up, and I think it won't be the only fund that steps into this space. We've seen a lot of funds being set up for the NDIS kind of thing, and didn't work out the NDIS as much as what the funds wanted. And this is probably going to be the next best thing that they all turn to. So again, the early adopters, the people that have got in now, I think you guys are going to make an absolute killing. You're going to get a cash on cash return, which you're already getting. And there's a chance that these funds could come through and just want to buy all of your properties off you for a ridiculous amount of money. So again, thank you for taking the leap of faith. We really appreciate you guys. I'm really happy with the way deals go. Like I say, some of these things can get held up at council. Some of them can drag on a little bit longer than we'd want them to as a company as well, because we make our money when we're actually renting these rooms out. So if properties are stuck in construction, then it's not very beneficial for us as a company, right? So we want them built just as much as our clients do. But you can see there that when these things are built, they're performing really well in terms of capital growth and cash flow from the same deal. And I don't think anything else like it in the market. You can keep chasing your hotspots if that's what you want. Chase your hotspots, claim your negative gearing back. But you tell me, if you're $10,000 a year negatively geared compared to $37,000 a year positive cash flow, who's going to come out with a better net position at the end of the day or the end of the year? I'll leave you with that one, guys. Thanks again for joining us on the HMO Property Show. Here's my little sign-off line. Remember, every master was once a disaster and every winner was once a beginner.